Hello everyone, I am Heru, the student of Executive MBA, IPMI International Business School. In this video, I want to share about corporate finance that I learned from a great and inspiring lecturer, Prof. Sembel. The objective after get the corporate finance course is to give us the students problem-solving skills in finance from the point of view of management, internal, and investors, external. At the successful completion of this corporate finance subject, students are expected to be able to explain important management decisions and interlinkage among them, apply financial management decision making tools in analyzing financial decision problems, explore and evaluate opportunities to create financial value to firms and investors, utilize logics of corporate finance to improve participants' decision in other business-related situations, demonstrate ability to discuss in the structured way hot issues that emerge in the business finance media. So required to understand at least 80% of 50 concepts in finance. 7 contents in corporate finance that we will share in this video are: first, financial management and time value of money. Second, capital budgeting. Third, analysis of securities. Fourth, capital structure and dividend policy. 5. Fraud risk management and corporate restructuring. 6. Corporate event analysis and portfolio investment evaluation. And 7. Financial shenanigans and market efficiency. Financial management is optimal orchestration of internal and external financial resources towards significant and sustainable value creation. Goal of financial management. First, basic objectives: profit maximization, wealth maximization. Second, operational objectives: timely availability of requisite finances, most effective utilization of finances, safety of investments, growth of the enterprise. Third, social objectives: timely payment of interest, payment of reasonable dividends, timely payment of wages, fair settlement with suppliers, timely payment of taxes, maintaining relation with financiers. For research objectives, researching into new and better sources of finances. What's to manage? Capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, risk management. The important that we learn in financial management, also we must know about principal-agent problem, good corporate governance principles, transparency, accountability, responsibility, independency, fairness. 4. Cornerstones of corporate finance. Core of value principles. Value is driven by returns on capital and growth and cash flows. Conservation of value principle. You can create value by rearranging claims on cash flows. Expectation treadmill principle. The more investors expect of your share price, the better you must perform to keep up. Best owner principle. A business's value depends upon its owner's capabilities. 5 business essentials from Prof. Ramcharan. Cash, profit margin, velocity, growth, customer focus. Time value of money. Time value of money is the concept that the sum of money is worth more than the same sum will be at the future date due to its earning potential in the interim. application of time value of money, mortgage and car loan payments, life insurance, personal finance planning, time deposit, contract values, damage in court cases, investment values, capital budgeting, company values. Now we talk about capital budgeting. Capital budgeting is planning process for investment in long-term assets. Decision-making criteria in capital budgeting: accept or reject a long-term investment proposal. Capital budgeting concept: estimated expected future cash flow, evaluate the project based on capital budgeting evaluation criteria, decide whether which project is good or bad. Two or more projects can be mutually exclusive, may choose only one. Independent may choose all good projects. Estimating cash flows. Three types of cash flows: initial outlay, operating, differential cash flows, terminal cash flows. Capital budgeting method: payback period. Other methods: net present value, profitability index, internal rate of returns. All three methods above consider all cash flows, time value of money, and required rate of returns. Analysis of securities divided 3. Fundamental analysis in accounting and finance is the analysis of business financial statements, health and competitors and markets. It also considers the overall state of the economy and factors including interest rates, production, earnings, employment, GDP, housing, manufacturing, and management. Technical analysis is an analysis methodology for analyzing and forecasting the direction of price through the study of the past market data, primarily price and volume. As a type of active management, it stands in contradiction to much of modern portfolio theory. Quantitative analysis is the determination of the absolute of relative abundance of one, several, or all particular substance present in a sample. Capital structure. Capital structure is the particular combination of debt and equity used by a company to finance its overall operation and growth. Optimal capital structure: take benefit, financial distress, positive, move to the right side of optimal debt ratio line, negative, move to the left side of optimal debt ratio line. Dividend policy is a policy a company used to structure its dividend payout. Put simply, a dividend policy outlines how a company will distribute its dividend to its shareholders. The structures detail specific about payouts, including how often, when, and how much it's distributed. There are three different types of dividend policies: stable, constant, and residual, each with its own benefits. Dividend policies aren't mandatory, as some companies choose not to reward shareholders with dividends. Paying dividends. If you pay dividends, stockholders receive an immediate cash reward for investing, but the capital gain will decrease, since this cash is not invested in the firm. So, dividend policy really involves two decisions: how much of the firm earnings should be distributed to shareholders as dividends, and how much should be retained for capital investment. Is dividend policy important? Three few points. First, dividends are irrelevant. Second, high dividends are best. Third, low dividends are best. Now we go to fraud risk management. Occupational fraud and abuse, divided in three: corruption, conflict of interest, bribery, illegal gratuities, economic extortion, asset misappropriation, cash, inventory, and all other assets. Fraudulent statements, financial, non-financial. The fraud hexagon: opportunity, need, character, competence, arrogance, justification. Reasons for occupational fraud: huge personal debt or losses, lifestyle beyond income capacity, over speculation in get-rich-quick scheme, gambling, perceived unfair treatment by company, pressure from family or certain group, alcohol or drug addiction, love affair with the same office. Fraud prevention, build employees' ethics, write SOPs that have to be followed if fraud even is suspected, discovered, identified. Train employees to increase alertness for fraud and how to prevent fraud, including financial control procedures, IT, security, and etc. Protective security, hardware and software. Creative whistleblower mechanism. Initial detection of occupational frauds, tip, internal audit, by accident, internal controls, external audit, notified by police. Whistleblowing, act on reporting misconduct to managers, executive, or other authorities with the power to take correction action. Whistleblowing is a tool to empower employees to identify wrongdoing and to protect the integrity of the organizations. Example of misconduct: violation of regulations, laws, or rules, behavior that threatens the public welfare. 4 types of incentive: physical, monetary, social, moral. We also see fraud statistics that's mostly case in age of 41 to 50 years old. Also education, undergraduates and master's degrees. Now we talk about corporate restructuring. Restructuring corporate structure, capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. How to surviving and transforming business. Stop the bleeding, financial restructuring, temporary pivoting, strategic realigning, redefining core business, new ways of doing business. How to overcome financial distress. Financial distress and turn around opportunity, we can do operation restructuring, asset restructuring, and financial restructuring. In financial restructuring, we can do private workout, file for legal bankruptcy. Financial distress, permanent problem, private liquidation, file for legal bankruptcy. Corporate event analysis. A corporate action is an event initiated by a public company that brings or could bring an actual change to the securities, equity or debt issued by the company. Corporate actions are typically agreed upon by a company's board of directors and authorized by the shareholders. In corporate event analysis, we can coverage and reporting, key announcements, market and analysis speculations, media coverage, first-hand information, information on attendees, speakers, customers, sponsors, and exhibitors, key themes, report customization as per client requirement, market implications. We practice portfolio investment. With Group 3, Cuan Investment, we manage share issuer, BBCA, BBRI, ICBP, MEDC, GGRM. In this corporate finance, we also learn about financial shenanigans. The 7 shenanigans. First, recording revenue too soon, recording bogus revenue, boosting income with one-time gains, shifting current expense to a later or earlier period, failing to disclose all liabilities, shifting current incomes to a later period, shifting future expenses into the current period. 10 clues to detect shenanigans: dishonest management, inadequate control environment, changes in auditors, outside legal counsel or CFO, changing in accounting principle or estimates, large deficit of CFFO relative to net income, substantial disparity between sales and receivable growth, substantial disparity between sales and inventory growth, large increase or decrease in gross margins, recording revenue when risk remain with seller, presence of commitment and contingencies. Now, last we talk about market efficiency. What is market efficiency? Prices reflects all available information. Those fin asset prices are fair prices. They are neither too high nor too low. What is meant by all available information? Historical trading data, publicity available information, all private and public information. Strong form, all information affecting the asset's value. Semi-strong form, all publicly available information. Weak form, information contained in historical trading data. Perfect capital markets. No barriers to entry. Perfect competition. Its participant is sufficiently small and cannot affect price by his action. Financial assets are infinitely divisible. No transaction cost. All information is fully available to every participant at no cost. No tax asymmetries. No restriction on trading. Strategy in an efficient market. Diversify. Select suitable asset allocation. Don't try to time security price movement. Keep tax consideration in mind. Passive investing. Index fund, dollar cost averaging. Thank you everyone for watching. Hope this useful and add insights. Keep spirit and healthy. Always be successful in life, business, and work.